Who loves taxes? Yeah. I bring up all the stuff that we have going on each time, and you know, he says I'm a voracious reader. My manuals for this year are 6 inches thick. I've got half a dozen of them. Most of you here, we've got 50 or so people here. Most of you own your own businesses. They are small businesses. They are pass-through entities. So I'm trying to be a little more specific. Instead of doing everything, I'm looking for stuff that affects entrepreneurs. Then in this case, I'm talking about people who have to deal with pass-through entities. Because your income for your business is also going to affect your personal tax return. We like to do them both at the same time, in case you're curious what we're talking about. Not just pass-throughs, but also sole proprietorships. So we're looking at sole proprietorships, people file Schedule C, partnerships, LLCs, anything you get a K1, S corporation. I am not looking at situations in this case where you own a C corporation, you receive a payroll check. It's kind of distant, separate from you. So all the laws, I'm going to take it in 2 parts. Let's look at the businesses first. There's a ton of changes. The ones that I think will affect most of the people here in the room for businesses would be, number 1, the accelerated depreciation, home office deduction, domestic production for our booze hound over there, hobby losses, and a big one this year for the IRS is the employee versus independent contractor. So taking a look at one at a time, the accelerated depreciation. This is anytime you purchase a tangible asset for your business, put it into use in this year, and it is new, you can accelerate the depreciation for 2013 up to $500,000. And it also includes software. This was a little addendum for a couple years that you can 179 software. Starting this year, 2014, they haven't patched it yet. So it's dropped back down tentatively to $25,000 for the year, and it does not include the software. They may patch that later on, but right now, when you're doing your purchasing in 2014, plan on not quite capitalizing as much. You won't get it quite as quick back. One thing that did change for a lot of you who work out of your home is a new safe harbor method for calculating in-home deductions, in-home office. Instead of having to collect together all your expenses for the entire year, depreciation, sales, or property taxes, interest, dividing it all up, it's now a straightforward option to take $5 per square foot for up to 300 square feet. You still get to claim the entire deduction for your mortgage interest and real estate taxes on your Schedule A. So if you itemize deductions, this may help you if you have a smaller office. This is just starting in 2013, and it is an optional issue. There are things you do have to watch for, though, because you still must actually qualify as a small in-home office. In-home office means that it has to be exclusive for your business. It cannot be a computer set up next to the dining room table. There are some exclusions for those of you who keep inventory. This gets skipped by a lot of people. If you are keeping inventory for your business at your house, it does not have to be exclusive. So if you have a rack of shelves set up in the garage that take up 10 square feet, you can claim that deduction. So it does have to be separately identifiable, except for the storage of things. So like I said, not the corner in the dining room. And it has to be your principal place of business for whatever services you're providing there. It cannot be you have an office in Santa Barbara, but you don't want to travel there all the time, so you also have one in your home. It has to be where you are meeting clients, and it has to be the principal point for those services. Advantages of this: there's no recapture of the depreciation. Since they're giving you a flat $5 per square foot, you do not have to track depreciation on your home, and when you sell the home, you do not have to recapture the depreciation you could have claimed. A lot of people don't do that, and they get into trouble when it comes to audit time. Disadvantage, there is no carryover of the excess. If you use the traditional method and your in-home deduction exceeds the profit of your business, you can carry it over and use it next year. With the safe harbor version, you cannot carry it over, so it's only good for the current year. Domestic production. This one I thought of, our cannot be named side job involving liquor. It's not your category. You can't talk about it in the chapter. This is a domestic production credit for those of you who actually produce something. There's a court case that went on last year. Normally it's people have just been grabbing it. I produce something, it's made in the US, I can claim the 9% deduction, which is a great 9% of your net income limited by 50% of your W-2 expenses. But it has to be production of tangible personal property or software. There's a big case this year in which a couple had self-produced a book, wrote it, laid it all out, made the cover, created a PDF, sent it to the printer to be printed, and tried to claim it all as a domestic production. The IRS has ruled it was not production because they didn't produce anything tangible. The printer produced the book. So you do have to be careful. Unless you are personally manufacturing the product, it's not a domestic production. There are some caveats to it. Anybody making movies or architects, there's some special things. But in general, you have to actually be doing the manufacturing to claim the credit. Hobby losses. This one became a concern with the turn down in 2008. We're coming on 5 years now. And generally the IRS rule for whether or not you are running a business or running a hobby is looking back at the past 5 years. So if you haven't been making a profit, some people are starting to get worried. The IRS and the tax courts have had some arguments back and forth on this, but in general, there's a couple of things they're looking at. Are you acting in a business-like manner? Do you have expertise in your field, or are you consulting with experts in that field? How much time are you spending on the project? Have you had success either? It doesn't have to necessarily be in this project, but in other projects. Are you a successful business person? Does your current business that you don't want to be qualified as a hobby have any profit or loss? Do you have other income that you're living off of? Because if you have another income you're spending most of your time at, it's hard to claim this as a business. And whether or not you enjoy it. If the IRS decides that your business is actually a hobby, what it means is you can't take any losses. You can still deduct the expenses of the business up to the income you receive. But you can't take the losses against your other income. So you want to make sure you're doing things like you have a bookkeeper, or at least a copy of QuickBooks. You're reviewing your financial statements. There's a case last year about a lawyer who was running a horse breeding company. And he kept his books and everything, but the IRS decided, and the tax courts agreed, since he was just keeping the history in his books, he was not analyzing financial statements and attempting to reduce costs, that it was not a business books. It was just a historical transaction to make the claim. So run your business like a business. Seek advice from tax people so we can keep you there. One thing, this one is a big court case this year on employee versus independent contractors. I got the statute up there for all you lawyers in case you wanted to look it up, or the court case. This was a construction company, hired individuals on a per project basis. Sounds like an independent contractor. But the construction company controlled the individuals. They told them what their assignments were. They did the negotiations with the client. They received the funds, and then they distributed it out to the individuals. They paid the individuals directly, and the individuals were not submitting invoices like a subcontractor. So the IRS and the tax courts have agreed these were not subcontractors. They were employees. So 2 minutes? Man, I'm not even halfway through. Let's do this a little bit faster. So take a close look at your employees, your subcontractors. Some things to look for: make sure they're invoicing you, make sure they're actually a business, they're reporting their own taxes. And generally, you want to make sure they're doing the same tasks for someone else. If they are only working for you and it's an integral part of your business, they may be an employee. We'll run through individuals real quick here because most of them are simple things that you see all the time. Maybe a long category. But personal exemptions, the phase-out returns this year. It's been excluded for 2 years to help things going out. If you're a high-income employee or individual, you can lose your exemptions. Long-term capital gains, this is new, has been added permanently. So if you are in, the big thing is if you are in the 10 or 15% brackets, your long-term capital gains are zero tax. So think of that when you're doing your tax planning. If you can get your AGI down to those lower brackets, you don't pay tax on stocks, anything capital gains like that. Itemized deduction, just like the personal exemption, the phase out is back. So if you're a high income, you may be losing some of your itemized deductions. Medical deduction threshold. If you are not a senior, this is increased starting this year from 7.5 to 10%. If you itemize and you claim a lot of medical, keep an eye on that. Altman, no longer a patch each year. Starting in 2012, it has been added permanently as part of taxes, and it is adjusted for inflation, so it'll keep up. The two new taxes starting this year, investment income tax. So if you have made investments, and this includes things like passive income, interest income, dividends, capital gains, rents and royalties for those of you who own second houses, there's an extra 3.8% tax for the investments that are over the threshold. It's the lesser of your income over the threshold or the total investment amount. So you need to keep an eye on how the income's coming to you. Otherwise, you're paying extra on that. And then there's also an additional Medicare tax, which is if you're a highly paid income. It's total income. So they tax you an extra 3.9% on your passive income. And if you have high non-passive income, it's an extra 0.9% to make your Medicare 3.9. So that was fast, wasn't it? One quick one. I just got to put this up here so you guys can see it, because a lot of people have been asking about the Obamacare individual mandate. It's just about the only part that survived for the taxpayers into 2014. This is if you do not have insurance in 2014. The exclusions for it: if you have a religious exemption, if you're in jail, if the premiums for your insurance on the bronze level be more than 8% of the total household income, if you're below the filing threshold, any of those reasons you do not have to have the insurance, other than if you break an arm or something like that. Penalties are the lesser of the national average for bronze, which as of September, people said that was around $249 per month per person. And then, or the sum of monthly penalties, which is $95 per person per month, maxed at 300%, no, $95 per year, sorry, maxed at 300% for the total number of people. 50% for children under 18. So if you've got 10 people in your house, it's still only 300% of that. It's confusing, but I did a quick calculation. If you want to look at it, I'll leave this up here. Basically, for a family of 4, Orange County median income is about $85,000. No insurance in 2014. It comes down to $647 for the year as a penalty for not having insurance. So, quick questions. Yes, Dr. Tron.
Are we still having a file 1099 for like rents and so forth and do that?
As a business, you have to file 1099s to any services that are not to an incorporated company. Any lawyers, whether they're incorporated or not. You do have to file one for rents if you are not paying a rental company. If you are paying a rental agent, you don't have to file it. If you are paying it directly to an individual owner, you do have to issue them a 1099 for rent. Okay, that's it.